Welcome, everybody, to this session, which follows on very neatly from the previous session, talking about the quoted markets, and the phrase that I took away at the end, which I think absolutely is what we now want to talk about, was that what really counts, I think it was Matt who said that, is the substance of engagement between companies and their shareholders or their potential shareholders, and that's really what we want to address now, is how do we make the substance of that engagement really effective. To talk to us about that, we have, to my right, Deborah Gilshan, who's the Corporate Governance Counsel at RPMI Railpen, which to many of us is basically the Railways Pension Fund. Andrew Buchanan, Fund Manager at Octopus Investments, with many, many years' experience of investment, particularly in managing AIM portfolios. And Mark Niznik of Artemis Investment Management, who's the manager of the Artemis UK Smaller Companies Fund. Tim just mentioned that the survey that we carried out for Baker Tilly and the QCA recently, where we interviewed 16 fund managers, including Andrew and Mark, about various aspects, both of their preferences in terms of investment and also about the engagement process. I won't try and quote that survey, it does have a top 10 tips at the back of it, and we hopefully will hear today whether some of those tips are indeed those that Andrew, Mark and Deborah think are the right things to be doing if you are a company trying to communicate effectively with investors. But I will just quote three things that came out, which I think I hope we'll address. One was that companies should view fund managers as investment partners. They should listen to them, and they should learn from their experience. So hopefully we'll find out how that can best be done. Deborah, do you want to start us off and give us a perspective, particularly from the point of view of corporate governance, of how should that be taken into account and best taken into practice in the engagement with shareholders?
Thank you, Alan, and thank you to the Quoted Companies Alliance for inviting me to speak today. I'm not just here to talk about corporate governance, I'm actually here to talk a lot more about the voice of asset owners, which I think has really emerged since the financial crisis. We are a pension fund. We represent the railway workers of the train network companies around the country. We have 20 billion of assets under management, which we invest globally. And we have a very strong investment in the small cap sector here in the UK. We have about 100 companies that we invest in the small cap and FTSE fledgling sector. I was struck by the comments in the earlier panel on monitoring and really the lack thereof of good monitoring by institutional investors, including asset owners like ourselves, and really quite disagreed with a lot that was said around box ticking and the use of proxy research providers, certainly for the pension fund that I work for and many other pension funds around the world. I think we have two roles to play in trying to improve the stewardship of the companies we invest in. I think Professor John Kay was quite clear in his review of public equity markets in the UK that really what had one of the causes of the financial crisis and one of the solutions is to try and increase long-term views that we have as asset owners and to improve stewardship of the companies we invest in. And I think we as asset owners put a lot of more demands on the fund managers as our intermediaries when we invest to improve not just the financial results and monitor the financial results of the companies we invest in and that they invest on our behalf, but also improve the stewardship. And Professor Kay said stewardship wasn't just corporate governance. It's not just the rules and the compliance of corporate governance. It's actually trying to improve the discussions that we have with the companies we invest in, and looking at strategy, looking at who's on the board, looking at how we pay our managers and our CEOs of the companies we invest in. And I would really encourage you as small cap companies not to see corporate governance as just a compliance exercise. We are really interested in how you use corporate governance structures to underpin value creation and protect the value that we are investing in when we invest in small cap companies. I spend a lot of time engaging on governance and other issues with our small cap and FTSE fledgling companies. I think there's a lot better governance momentum for change in small cap companies. Often they want to do the right thing and really appreciate the views and the input from institutional investors like ourselves, the asset owner, as representing the underlying beneficiary. And I do think we have a different voice in engagement and stewardship than fund managers may have. And that is not to disparage the voice of fund managers, but I think we are trying to create long-term relationships with the companies we invest in. And we are your ultimate long-term shareholder. We will be there with you through AIM if you do move to the main market, and then if you grow through to FTSE 100 to the larger companies. I think some of the larger companies do walk the walk and talk the talk on engagement and governance, but I feel that we can have a real impact in small cap companies because they do really look to us as their shareholders for advice and for agreement, and use us as your sounding board when you're thinking about making changes on the board or making changes to your executive pay arrangements. So I guess my main message as a pension fund investor who does have internal resource on looking at these longer term stewardship issues is that we want to have good long-term trustful relationships with you, and that it's a two-way street, and that you engage with us and that we'll engage with you as well. Thank you.
Thank you very much, Deborah. Now, Andrew, sorry, just Andrew, I mean, as a CFO of an AIM company, I'm very acutely aware that twice a year I turn up and have to plan and organise and then carry out an extensive roadshow. I think both Andrew and Mark will talk both about the pre-IPO stages and the companies already on the market, about the things they particularly like to see or don't like to see in those meetings.
Good morning, everybody. It's nice to see a few familiar faces, even if someone has already warned me that they're sitting in the front row and have got the box of rotten tomatoes under the table. But that won't stop me saying what I think, so I'm going to do so. Errors in meetings. I thought I'd just stick for probably the first time in my life to answering the question, so to speak. And I've just made a few notes of real hobby horses. The first is use white paper. I saw a company, I don't know, about a month or two, 6 weeks ago now, thinking about floating on AIM, and I think the corporate colour is black. So everything, every page of the wonderful PowerPoint presentation was black. And I made some comment about, are you in mourning for Queen Victoria? To which my colleague said, yes, you remember her funeral, don't you? It is impossible to scribble on coloured paper that's been covered in ink. A, it's frightfully expensive and clearly profligate, and that does no good for your dividend payments. And secondly, actually, we do keep them, and so we do scribble on them. And if we can't scribble, well, you're at a disadvantage already because I can't remember who you are. I'm that sort of age, and actually almost at Queen Victoria's funeral, but not quite. So if you could just help us, I mean, that probably offends all sorts of people who think their brand image is frightfully important and that sort of thing. I come from a company that thinks its brand image is frightfully important, so I won't comment on brand images. But I do think that you need to help us by just allowing us to make some notes, please. So there you are, point one. Second, if you get asked a straight question, give a straight answer. You probably, lots of advisors will tell you that. And actually, there was a case in point where several years ago now, this broker said to the chief executive, this man, you're going to see Andrew Buchanan, he will ask you a few straight questions. Just answer them. So I asked the first question, and I got some politician's flannel. And then I said, excuse me, the question was, and I got some more flannel. So I thumped the table and said, the question is, yeah. Anyway, he didn't get any money, and he actually went bust. So I'm sure there's a message in there somewhere. But what it probably means is that actually he didn't know the answer. And it was, I can't remember what it was now, but it would have been a straightforward, simple question, because I'm incapable of asking any other sort. If he didn't know the answer, then clearly the information didn't exist, arguably the business wasn't being run very well, and perhaps that's why it went bust. So those are the sort of ways in which we behave, I'm afraid. We're looking for all the signals, all the extra bits and pieces of body language, and indeed what's not in the answer, reading between the lines, however verbal they may be, as much as what is precisely said. It might be just one additional help for us if occasionally we ask almost the right question. We're very nearly there. We're just sort of kind of working out what is the fundamental KPI in your business or something. And we don't quite get it. So you might answer what we're told, what we've asked, but you might then want to add, but did you also mean such and such? Because if we then discover 2-3 months later that, oh, I thought I asked that, and they didn't tell me, what else are they hiding? So it is worth, I think, just actually saying, is that what you meant to ask, or did you mean as well? And that begins to create some of the trust, perhaps, that Deborah was talking about. Remember that you're persuading us, you're not selling. Overly slick presentations are not necessarily frightfully helpful. There was a lady once who came and a frightfully good prospectus, and needless to say, I'd read it from cover to cover. And she was on her 4th marriage. So some of you may have heard this story. I have checked. She's not in a room. And she said, and it's not for repetition outside these 4 walls, I should say. And to stop her in mid-flight, I had to think of something. So I said, are you as good at running your business as you are your marriages? And that did, yeah. I'm clearly went to some unknown school of diplomacy that no longer exists. It obviously went bust too. The other things I think very quickly to remind us all of are that we don't, as investors, have to invest. We're not just looking at companies in your sector. We're looking at companies right across the entire spectrum, from A to Z in the economy. So we don't have to invest in the whatever sector. And so you are in competition for, if you're raising money, for an awful lot of other companies. And there are thousands of them, and sectors are pretty sort of unimportant as far as I'm concerned. I was asked to make 1 or 2 comments about floats in particular, because there seem to be quite a lot of them at the moment. The pile of prospectuses hasn't quite fallen over on my desk. But when it does, we know we've reached the top of the market. It's not quite over yet. But I have to say that we are beginning to see people who still think that they will run the business. If you've had private equity backing, of course, the my company syndrome doesn't probably apply. But we are seeing people who still think that it's my business. It's all of our businesses. And that, I think, is the point about corporate governance. Mechanistic corporate governance is undoubtedly rubbish. But corporate governance to the point that means an attitude of mind, it means that you want to run a public company with fellow shareholders, that's great. And I think if corporate governance achieves that, then actually it does achieve something. I have to say that if there are 2 particular errors that stick in my mind, it is companies where I thought a major dominant founder was going to have their shareholding slowly reduced over time below 50%, and it never happened. And both businesses were, from an investment point of view, a disaster. Finally, probably unlike me, it's worth smiling, it's worth relaxing, it's worth enjoying it. It is definitely something that it isn't a complete torture chamber. I think I was the very first presentation that one chief executive gave when he was floating his company many years ago. And he was as nervous as possible to be. He was sat there and rigid, and he said, you know, what it said on the piece of paper, really, and so why he was there, I don't know. I think I could read. And then suddenly, the broker in the room, the telephone went off. And that won't happen in the next 2 minutes, I know. I said, good Lord, there's a broker in the room. And this chief executive said, the extraordinary thing is someone wants to talk to him. Whereupon we laughed, the broker went bright red and answered the telephone. We roared with laughter, and he relaxed, and actually turned out to be a hell of a good investment. So do enjoy it. It isn't an audition, and it isn't an ordeal. Thank you.
Thank you very much, Andrew. Mark.
Well, I'm feeling quite sheepish after that because Andrew was talking about the lady on her fourth marriage. Well, I'm on my third, so hope that doesn't mean I'm a bad fund manager. But anyway, I was going to just talk for 5 minutes or so just on this topic of errors made with meetings with investors, or where I think. I suppose to start with, I can only talk for myself. I think every fund manager is different. You get lots and lots of different views. Most of what I say is going to be common sense. So sorry if I'm stating the bleeding obvious, but it is. So given that intro of every fund manager different, I suppose the first point I'd like to make is, if you can, try and do your homework on what that fund manager is actually after. I mean, some people are sales junkies. They want to see your company growing the sales very, very quickly. Some people are more interested in internationalization of the business and global opportunities. Other people are very interested in dividends and dividend yield, the income guys. If you speak to me, I couldn't really give a monkey's about dividends, but I'm very engaged with cash flows and return on capital. So your broker can help with that. Hopefully he's got a relationship with the fund managers. He'll be able to kind of point you in the right direction of what they kind of like to see, what they're after. Maybe what their other investments. You might be a company that has a quoted competitor that maybe has filled that fund manager's mind with negativity or positivity for you, so you can cross those, have those answers ready up your sleeve. The fund manager's website will typically have video chat and interviews with what the fund manager's process is and what they like. So I suppose doing your homework and maybe tailoring a bit your chat to what you perceive that fund manager wants is very, very helpful. I think this word has been mentioned by both Deborah and Andrew, and that's trust. I mean, to me, trust is probably the most important thing that you want to try and build with your investors. And I know it's a bit rubbish to say that, given some of the portfolio turnover of some of the small cap investors, that we say we're long term, but when it comes to it, we're probably not. But I think the important thing, for me anyway, it takes me a long time to build up a trusting relationship with someone. And we are, well, I can speak for myself, but we do invest for the long term. So we generally take a multi-year view of life. And if you can build that trust, there is generally plenty of money there. I mean, fund managers do have lots of money. So if you do need funding for future takeovers, acquisitions, whatever you need, then it's there if the trust is there. And to me, you build trust by, I think Andrew mentioned, don't oversell. Just tell it how it is. So every company has hiccups. I'd rather be told of those hiccups up front rather than have to drag them, buried in some note in the account somewhere or deep in the CEO's or the FD's report. So I think trust to me is very important. And I think the third thing is I'm not sure whether I should say this, there's probably someone from the stock exchange here, but is lowball expectations. So to me, whenever a chief exec or a finance director gives some kind of view about the future, I want that to be a conservative view that I can kind of hang my hat on with. I mean, nothing's certain, but if you've got a 3-year plan that says your profits are going to go from 5 to 7 to 9 to 10 million, then I would always encourage your you to encourage your brokers to lowball those estimates. So to aim off, because you never know what hiccups are going to be in the road ahead. And if you look at those companies that do miss their forecasts, they are very, very severely treated by investors, and it takes a long time for us to kind of get over that kind of the hurt, if you like. So I think having conservative expectations in the market is quite useful. In terms of in-meetings themselves, I think another good thing is to have a kind of a balance to the meeting. So what you really don't want is the kind of dominant chief exec to be hogging the meeting totally and not letting anyone else get a word in edgeways. That gives off a kind of a one-man band vibe that I would certainly turns off me. I'm sure it turns off most investors. If the fund manager asks a financial question, you would expect that to be answered by the finance director, not the chief exec or the chairman. So I guess you want the right guy to answer the right question. I think it's also helpful actually if you mix it up, maybe who you bring. So maybe sometimes bring the marketing director if that's relevant, or if you're a techie company, a chief technology officer, or the COO. That shows breadth and depth rather than just seeing the same face every 6 months for the reporting meetings. I think other things. I don't know about you, but I kind of think as the years have gone, the reporting season has got more and more crowded, and more people seem to be reporting results at the same time. And I frequently can have 6 or 7 meetings in the day, and you feel like you're going from one meeting days to the next. So if you can report your results early, I don't know how you fix that with the auditors, but I'm always very impressed. There's one company, Senior Engineering, which I own. They already have their report and accounts with them, printed and fully ready at the time they're doing their prelims results show. And I was quite impressed with that they've got their accounts so slick. What are we doing for time? I suppose to me, I think I asked someone about what other points we could raise at this thing, and she was saying keep it simple, stupid, which I quite like. If you can't explain your business to a non-financial person in a fairly easy, quick manner, then I don't. It's going to be hard. Certainly, I'm not the brightest bunny in the world, so keeping it simple is very useful. I think don't make the accounts too glossy. So it should be I think Andrew touched on the kind of black paper thing. To me, you should tell it how it is and not gloss things up too much. A little bugbear of mine is when companies' profits go up, they normally put it's gone up plus 20%. When profits go down, you sometimes leave the minus 20% off, and that kind of pees me off a bit. But there you go. And the other thing is if there's a kind of a lumpy profit that in the period you're just announcing, not an exceptional item, but just something that's a bit kind of one-off-ish in nature, then be sure to mention it, because the next time when you're comparing against that lumpy profit that isn't there this time that was there last time, people will remember. So try and be consistent. I think that's all that I've got to say. So leave it for questions. Thanks.
Thank you very much, Mark. Well, thank you to all the panelists for absolutely sticking to their allotted time, which gives us a good plenty of time for questions, of which I hope there will be many. So, as I said, for me, certainly, this process is one of the most important parts of my annual cycle is the interaction with our shareholders. So I'm sure they ought to be of interest to those in the room. I don't know if we've got the microphone somewhere around. Would anyone like to kick off with a question for the panel? Over this desk here, the table here. If you could also remember to say your names when you give your question.
Hi, it's Richard Crump here. I'm from Accountancy Age and Financial Director magazine. I guess I was interested in how much the investors in this process like to speak to auditors and how accessible auditors make themselves and how valuable the information they provide is.
So investors speak to auditors. I'm just going to see if there's any other, just trying to group any other questions. Anybody has any at this point? Okay, do you want to pick that up?
Well,
yes. Far away, Richard.
I guess Mark also mentioned about not to have reports too glossy. And I just wondered what they thought then of things like narrative reporting and integrated reporting. Is that making them overly glossy at the front end, or does it just a valuable tool to communicate a business model and how it works?
I might add you a third question, which I know sounds overly cynical, but I'm pleased to hear you actually read the annual report, because I do wonder sometimes whether people actually got through it all. Andrew, do you want to kick off on the talking to auditors and the annual report? How useful you find that?
Insofar as it's a straight question, so you'll get a straight answer. Do we talk to auditors? The answer is no. I would certainly read the auditor's report for what it's worth, but yes, sorry, there are some auditors in the room, I should be careful. Yes, certainly read the auditor's report, certainly read a report and accounts. I would tend to agree with Mark that actually, they're unbelievable doorstops these days. Who decided that we need quite as much as all that? I really don't know. The trouble is you're addressing a lot of different audiences. So you're addressing perhaps professional investors on the one hand, you're addressing lawyers and goodness knows what on the other hand, and you're addressing, the ordinary man on the Clapham omnibus, which as far as other companies are concerned can include me. So it is difficult. But I'm not sure that it really has to be a major marketing document, which is probably what Mark is getting at in terms of glossy. But it needs to tell us what everybody wants to know.
Deborah.
On the auditors, we've been doing a specific piece of work in raising these issues through our voting at companies' annual general meetings around the tenure of auditors and also the level of non-audit fees. So we actually engage with audit committee members on issues around auditors and lack of independence. Obviously, the auditors are available at the annual general meeting of companies. So we do occasionally have individual conversations with auditors themselves, but also engage on public policy issues with all the big audit firms as well. So there is a level of engagement around audit issues and auditors themselves. I do read annual reports for my sins. Some of them are larger than others in terms of volume. Some of them are very good documents telling you not just about the company itself, but the strategy of the company and how the back end of the report, the financial accounts, underpin the front end of the report, the strategy and who's on the board. So I think there are lots of good annual reports out there, and I think we are quite clever as shareholders being able to cut through some of the marketing hyperbole and hype that we read. But there are some very good documents.
Thank you. Mark.
Auditors know integrated reporting. I'm not quite sure what that is, to be honest, but less is more as far as accounts go, to me.
Next question. At the front here, and then one at the very back.
Do I need a microphone?
You will for anyone to hear you at the back. That's the problem.
Martin Brooks, IDOX PLC. I was wondering if I could just move on from some of the answers you were giving and ask the panel what their view was on the tenure of auditors. I mean, the rules are now, that's moved into the big cap and the fully listed sector. But in terms of aim, do they have views on that?
I mean, I just think we want to ensure that auditors aren't there for a very long time. I mean, some of the numbers you've seen in large cap companies about the length of auditors, 7 to 8 years. Some companies can't find the actual date of appointment because it's been that long. I mean, from a shareholder perspective, that's quite worrying because obviously the audit, the function of the audit is there as a shareholder protection issue as well. So, yeah, I mean, I think we're trying to, raise the whole idea of the audit being a very important piece of work from a shareholder perspective, rather than, quite frankly, the way some audit firms see it as a loss leader to other more lucrative work that audit firms can provide.
Mark.
No, I think to that one. I suppose my point is one of building up trusting relationship with the Chief Executive and the Finance Director. if it comes to me worrying about the auditors and that the company's that dodgy that I'm worried about whether they're good auditors or bad auditors, then I've made a bad investment probably. So yeah, no.
Andrew?
I think if over a certain amount of time, it is quite possible that a very small company you might have invested in 10 years ago and you're still a shareholder may still have a very small firm of auditors. And therefore, it is potentially possible that it's time to move on. That, I think, is probably the most obvious instance of where a shareholder might say to a finance director, should you change your auditors? You then probably hit a certain level of resistance, perhaps, because it's like nice and comfortable, which tells you that Deborah's got the right answer. But I think that's the obvious example. Otherwise, on the whole, they're as regulated as we are, if not more so, heaven forbid. And so the notion that they're actually going to do something that's not entirely above board is pretty monstrous. And I'm looking at a finance director. So, I think that, yes, if there is a reasonable sized one with a full capability of both sensible experience and advice, then probably you've got a reasonable auditor.
I'm going to come to the person at the back, I think with the blue shirt in a minute. I'm just going to ask a question of my own just to build on that. A couple of you have mentioned, there's various examples of corporate governance and rules now, for example, on executive remuneration and requiring shareholder approval for companies that are on the main listing, main board. Do you have a view about whether AIM companies should be aspiring to follow the code as if they were FTSE 250 or FTSE 100 for that matter, or do you feel that it's AIM companies should, generally speaking, stick to what they're only required to do? Maybe I can start with Mark on that.
I'm not sure what the rules are, but whether it's an AIM company or a fully listed company, I would certainly want the execs remunerated on the basis that they only make money if I make money over the long term. So there's a kind of a building of alignment of interest. So whatever plan that delivers that, that's what I would be.
More broadly, I was thinking also about the general combined. Well, they're not even called combined codes anymore, but the various codes that the larger cap companies are supposed to follow, which AIM doesn't strictly have to follow. Do you have a feeling that you expect a company to sort of start to put these into place, or do you think that the benefit of being on AIM is precisely you don't have to follow all those to the letter, therefore don't do it?
I'm not a big one on codes and number of non-execs and all their tenures. Yeah, that doesn't help me. I don't think that makes the company a better company. To me, if it's non-execs, then they should be there to advise the company and help the company. And how long they've been there doesn't bother me. So, but the exec remcom stuff, I think, is important. I do pay a lot of attention to that.
Andrew?
I did ask at an AGM once why the chief executive had a pay rise when the dividend hadn't gone up, but and it does seem to me that remuneration ought to be a reflection of a success of the business. So just to award yourself a 25% pay rise for good measure is not something that's going to endear directors and senior management to shareholders. I think, though, that whether there are rules on the full list that should apply to AIM, the answer is no. I think there are enough rules on AIM, and if you're going to make another one, then you've got to chuck one out. So I think that rules about remuneration, they were in the prospectus when you first invested. They're in the accounts to the extent that they change. You can see what the figures are. You ought to be looking. And then you are within your rights to ask a question.
Thank you. Deborah?
I think this question goes to the point about substance of well-governed companies rather than, ticking the box. I think regardless of which market you're on, agree that alignment of interest is absolutely key to good remuneration structures. And, the reason why we have governance codes for the larger companies in the main market is to try and deal with the separation of ownership and control, and I think that's true on AIM as well. I think we try to be very pragmatic with the companies we invest in, whether they're FTSE fledgling, small cap or AIM, understand the markets that they're in and the expectations. But certainly, and I think that the Code of Governance gives a little bit of leeway for small cap companies in terms of board size, but ultimately it's about the privilege of access to public capital, and there's rules and regulations and responsibilities that we should meet as shareholders and companies should meet as companies on those markets. But I think going back to the trust point, one of the key reasons why we want to have good relationships with the companies we invest in is because we are often willing to accept deviations from code practices because we understand the companies we're investing in. We have good long-term relationships with the board of directors, and we actually understand what they're trying to achieve. And so we will be willing to consider, what board structure they want to put in place if we understand over the longer term they know where they want to get to and we agree with the delivery of the strategy. And I think that's a really important point and really does stifle the accusation of box ticking that so many shareholders get thrown at them.
Okay, thank you. Back to the questioner at the back there who I cut off, sorry.
Thank you. Matt Butlin from Allenby Capital. I was just wondering, when you meet a company for the first time, is there anything about the board structure that is a real turn-off, be it non-execs with stock options or, quite significant shareholdings or husband and wife teams or anything along those lines?
Andrew?
I suppose the real turn-off, if you meet a company for the first time, if by first time you mean it's in the process of trying to float, that the non-executive directors were appointed a couple of weeks ago, that is certainly a bit of a question mark in my head. I'm sure Mark will have a few others instantly, but I think I'll give him some time to think about the answer. That is certainly one, and the source of those non-executive directors is invariably something that one ought to think about and inquire about. My next door neighbour or something or other is probably not the right answer. I also think that, well, coloured paper, I've said that, but I think I think too the other thing that is a turn-off, something I just sort of touched on. I know often a name company is an owner-manager business. It's seeking equity capital, which is, of course, the right thing to do, not debt. It's seeking to sort of grow up and expand and enter new markets, do whatever it's trying to do. But the price for all that is that it is no longer, it's a manager joint-owned company. And I think the other turn-off is just the lingering suspicion, somehow or other gained by investors, that we're doing this because there's no alternative, but actually the other alternatives are worse, but my heart isn't really in this process either.
Deborah, are you meeting people for the first time? Oh. Sorry, board structures is the question, beg your pardon. What sort of structures on the board?
Well, we obviously prefer that the roles of chairman and chief executive are separated for reasons that I hope everyone understands why shareholders prefer that model. I think ultimately the role of the board is to hold the CEO and management team to account, and we don't quite understand how that can happen when the CEO is leading the board. We go to quite a lot of annual general meetings as well, and when the CEO is answering the questions around his own pay, sort of really doesn't give you a good feeling that there's an independent oversight of executive remuneration. But I think ultimately it's about people, about who's on the board, and you can, as someone said in the earlier panel, you can meet every single good governance rule and code recommendation in the world, but it's actually what happens on a day-to-day basis and how the board works together and how they oversee the management team. So I think that's why we value face-to-face meetings to try and really understand companies.
Mark, any thoughts?
I'm sure there are lots. I've jotted down a few. Generally, I agree with Deborah on chairman and chief exec. I think they should be separated. I don't like boards being too big. Again, most of the answers seem to be less is more, but so compact boards I prefer. I like the directors of the company to own shares in the company that they work for. Again, that's one of the best tips for me, is when someone's willing to put their money where their mouth is, buy their own shares, and I'm buying shares at the same price. That's does it for me. But then again, I don't want them to own too many shares such that they own a majority and I'm stuck as a minority holder. So it's kind of, there's somewhere in that happy medium there. Yeah, they're the main ones, I think.
Can I just add one more thing? I think what really worries us as well is when we feel that there's a bit too much coziness on the board. You know, the non-executive directors, they don't really need to be friends with the chief executive. The dynamic of a board should be a healthy tension. And anecdotally, I do a lot of work with US companies where the roles of chairman and chief executive are often combined. And one director did actually say the words to me, you know, he's there as the independent director leading the other external non-executives, and he did actually say the words to me, you know, don't worry, I play golf with the chief executive. And, you know, our pushback on that is it's of no comfort to us as shareholders if you play golf with the chief executive. You should be able to demonstrate to us instances that you hold him to account and that you've led the board through, you know, not necessarily a disagreement, but a healthy discussion on strategy, and there's been some resolution, and that not all the time the CEO gets his own way. And, you know, errors to make in meetings, that's one of them.
Don't come in your golf shoes. You mean. One just behind you and then at the front. So in the middle, so second or third row back.
Hello, my name's Tim Anderson-Edward from Independent Audit. So I declare an interest in board evaluations. My question is this: how seriously do boards in AIM undertake their evaluations annually, and how engaged do you as investors get in that process, and how seriously do you take it?
Just to clarify, you mean the evaluation of the board's performance?
I do.
Right. And let me take the other question here as well, and we'll take both questions. I think there's Gavin here.
Gavin Oldham. Institutional investors are in a very privileged position because of the weight of their holding. They can actually have an interview directly with the chief executive and the finance director, etc. I wonder if you could tell me whether you'd have any opposition or any resistance to having your meetings with the executive team filmed and then webcast so that they were available to personal investors who didn't have the same privilege.
Interesting question. Do you want to, Mark, you want to kick off with which, either answer both or one of those, whichever
the first question, I didn't really understand, to be honest. Do you mean evaluating the performance of the board and whether the board's acting as it should, or whether the company's doing well and holding the board to account? I didn't quite understand.
No, I mean board effectiveness. So when the board does its own evaluation of its performance and looks at the governance structures and how well it's getting its sources of comfort, how the relationships and dynamics are working between executive and non-executive, and what that means overall for the business, that sort of thing.
Right, no, really.
That was clear.
and the second question,
So
I would
no
definitely
business there,
object
then.
to being filmed in a personal meeting, but I think it's a very good idea that companies film their results presentations and put it on the website and put the slides on the website. I can see there could be a conflict with competitive issues in some companies, but having more information to everyone at the same time, I think is a really good idea.
Well, just a matter of government, we are obliged to put our shareholder presentations on under Rule 26 in any case, yeah. So the
Sorry, this is AIM, is it?
Yeah, in AIM.
So the AIM
There are plenty of
presentations
companies
have
that
to
don't put their presentations
They're supposed
on.
to go on the website. But the point about the webcast is an interesting one as to whether that's also. Andrew, do you want to comment on either or both questions?
I don't think we're intimately involved in the board evaluation, but obviously we are involved in an evaluation of the board as investors. To a large extent, that's what it's all about. So we are concerned about that. It's a matter of how you do it. So we're not, probably not allowed to see board minutes or anything else. That's called inside information. We certainly do evaluate the board for our own purposes as investors. I'm glad, Mark, you said you objected. I think that's an intriguing question, and well done, Gavin. It's one you would ask, isn't it? I think I would object too, but only simply because that's here and now, and I honestly haven't thought about it. How it would be managed, would we behave differently? Yes. So would it be as effective as you want it to be? Possibly, possibly not. But what's to be done about individual shareholders, of which I'm one in other companies, is an intriguing question in general, and one that I suspect is going to come to the fore, care of technological change.
Deborah, thank you. Do you want to talk about board evaluation?
Yes, I just wanted to say more generally, I'll comment about board effectiveness reviews and board performance evaluation. I think as shareholders, it's a really underutilised tool that companies could use much better to explain to their outside shareholders in annual reports and in engagement meetings with the chairman, for example, how they use board effectiveness reviews to really ensure that they are doing the right thing, being a good board, and also how they improve themselves as well. I think that there's lots of good reporting there around what boards have learned from a very robust performance review, but also quite poor reporting where it's literally the same two sentences every single year that says an effectiveness review was undertaken and the board was found to perform well. That really tells me nothing at all. And, if you cut and paste that every year, what value are you putting into that process?
Could you enlighten us, and you can tell how often we've done one on our board, by this question, in terms of formal reviews, what do you think are the essences of a good review then, if you don't, other than a board asking itself the question and then giving itself a big tick?
I think you should have an external review quite regularly. The Code of Governance does recommend that. I think a questionnaire that you just fill in and give back to the chairman, I don't think really would bring out, sort of key issues that board members need to be thinking about as they interact with each other. At the end of the day, a board is a group of human beings, and there'll be times when they're performing very well together and other times that they are facing challenges. So I think there are, good processes out there, but other processes that are undertaken that worry us.
Thank you. So it looks like there's one taker for the business there for independent audits, but I'm going to take one last round of questions, so I'll try and take one batch and then we'll be finishing. So there's a gentleman in the white shirt there in the middle. If we can take your question, and one over on to my left in the far corner, left-hand side.
It's Andy Blundell, Chief Executive of Communities. We're a full list business. Just two observations on shareholder communication that may help. First of all, the retail investors. We do a lot of that. We do these speed dating type events for companies, 200 people in the room. We like that, and we get very good questions in that kind of environment. The other thing we started doing is YouTube. We put quick video clips to YouTube on announcements, not just on results, and that goes down well as well. So I think new technology is my business, so I would say that provides a lot of avenues to improve communication to all groups of shareholders.
I mean, certainly speaking personally on this, I'm certainly aware of the issue that one is communicating a certain way with the larger shareholders who have a privileged position as a result, because we see it on a roadshow, and that a retail shareholder wouldn't, or a small shareholder wouldn't necessarily get all of that information. So I think I certainly welcome ideas about how to do that.
Hello, I'm Bob Beveridge. I'm a portfolio non-executive director now, former finance director. I like this idea of trust. I've always tried to have an open relationship with investors when I was finance director. But can I ask how you think we should react as companies when investors sell shares? Because the trust is a two-way thing, but you have actually got a slightly different length in terms of objective. How should we react when you come to sell the share? Should we inquire as to the reason why? And should we try and re-engage? Or what advice could you give us in that scenario, please?
Mark, you know? What happens when you quit?
I suppose, not to get too upset, I suppose. I suppose I kind of look at it, your job is to look after the business and mine's to make a comment or make a view of the share price. And if the shares have gone up a lot, that's just my, and I sell, that's just my view of the valuation, the value that I see. So it has no, doesn't have, that could be a disconnect between, you're still a very good business. And so to me, there are good businesses that keep on being good businesses into the future. And I always want to keep an eye on them because their share price might fall to a level that I want to buy back in. So I suppose not to get too upset. Absolutely, I'll ask why, and I'll always be happy to tell. What I probably should do is a lot more of is be upfront and say to I've sold your shares and this is why. To be fair, I don't do that very often. I do with maybe big stakes, but I don't do that often enough. To be honest.
Andrew?
It's a two-way street, isn't it? So from the point of view, if we're asking you questions, there's no earthly reason why you shouldn't ask us one too. And if you want to ask why you're selling, then I hope that we can give you a straight answer. There will be all sorts of reasons. And it depends on what sort of portfolio, what sort of clients, and all that sort of thing. But it will be partly, undoubtedly, Mark is right, a comment on the share price in relation to the business. It may be that, hold on a minute, you now represent 10% of my portfolio, and the directors get a bit upset in the fund if it's more than, let's say, 8%, you know. So thank you for performing so well, keep it up, but I'm sorry, I've got to sell a few shares. There can be a host of reasons, and I would just say, yes, ring up the fund manager and ask. And if you don't get an answer, persist.
Thank you. Deborah, any comments on that?
All of our funds are externally managed by external fund managers, so what we actually do is try and understand why they buy and sell companies as well. So it's not speaking directly to you as the company, but actually understanding the process from a client of the fund managers.
Well, thank you very much for all those very straight answers to pretty straight questions that the panel has given. I think it's been very enlightening and certainly given very, very practical information to all of us who go through this process. So can you join me in thanking the panel for a very useful session?